Welcome everybody to the October 2023 real estate market update with Catalyst Funding. We're bringing the latest and greatest from the real estate market, and a lot of people rely on this every month, and we're glad to have you back. So we have with us today our founder and CEO of Catalyst Funding, as always, Wade Comeaux.
Hello, everybody.
Today we have our Director of Lending, Jeff Johnson, with us as well.
Howdy.
And we're working through a few technical difficulties with our special guest, but we'll go ahead and introduce AG, the president of Alexander Green Developers, AG Gupt. So we're working through a little tech issues with the camera on that, and we'll get ready here to dive into the real estate market update. While he's working on his camera, I do want to offer this disclaimer that each month our presentation of this information it's for information only. No documents or estimates presented here that represent any financial determination or investment performance. We're just basically our agents, our guests, our representatives. We're not guaranteeing any rate of return on your investment. What we're trying to provide is valuable knowledge that you can use to make your real estate decisions. Just like Catalyst does when we have our VIP mixers, we want to be a part of you building your team, be a part of your success journey as an investor. And so that's exactly what this webinar is for, to add valuable knowledge as you make your moves. We'd like to be a part of it. With that being said, I'll turn the mic over here to Wade, and we'll dive into this month's real estate update.
Perfect. Thank you very much, Derek. And whenever we are able to get AG in fully, we'll definitely get his opinions. He's been in the real estate investment space for quite some time as a former co-founder of Real Acquisitions and as a current leader of a very exciting development company doing development for real estate. So anyway, let's dive in to the Catalyst value proposition. I want to talk a little bit about what we do at Catalyst. Most of you have heard this before, but I do want to cover a few things. One, we are a one-stop shop for all your hard money and permanent financing needs. We specialize in the space of single family 1 to 4 and small multifamily. And we're real estate lenders built by real estate investors. I personally own pretty solid sized single family rental portfolio. I'm also involved passively in some other real estate investments, and many of our teammates are also very active real estate investors, and we try to bring that experience to you to help you avoid mistakes and succeed in real estate. We've been involved in thousands of transactions over the years, and we have a single point of contact model for all your loans. So we have one fully licensed loan officer that handles your pre-approval for hard money, all of your takeout strategies, whether it be non-qualified mortgages or no income doc loans or conventional loans. They'll help you in that small multifamily and also in that single family space. So very well-rounded loan officers can be your guide to whatever product fits your needs and that individual investment. We also offer primary refinance, purchase, and cash out loans. And we have 9QM with FICO scores as low as 620. We also offer short-term rental loans for no income doc and no debt service ratio type investments as well. So really strong value proposition overall for you as a real estate investor, very well-rounded. And we want to dive right into Houston. And Jeff, why don't you cover this Houston slide for us? And as soon as we get AG able to work through those technical difficulties, we'll get his opinions as well.
Yeah, I'm multitasking here, trying to get AG the technical information. So here's Houston. It's a very similar story to what we've been seeing lately. If you look at the overall activity, it's down relative to last year. And if you look, it was interesting because we always talk about 19 numbers because we want to give some balance on like what's happening now versus before the pandemic, because the numbers were just out of whack for that time period. But I was reading the article from HAR, and I'd like to think they stole it from us. They've started comparing stuff to pre-pandemic. So like all of the, maybe they've been doing it for a while, I just noticed it, but a lot of their data is they'll compare now to a year ago, then they'll always reference back to 19, which I thought was interesting. So anyhow, total dollar volume 3.3, it's down roughly 10% last year, up almost 40% from pre-COVID numbers. Listings are up. Sales are 6,800, I'll call it 6,900, which is down 11%, which is not surprising given the current interest rate market we're in right now. Slightly down from 4 years ago. If you look at the average price, that as an investor, that's what I'm concerned with a lot. If you look at now versus a year ago, it's relatively flat. The average price is up 1%. The median price is down 2%. So Houston has been pretty flat year over year. Now, if you look, obviously, 4 years ago, your returns are much greater. You're at 40% almost on the average price and 36% on the median. Months of inventory is up to 3.5 versus 2.6 last year. But again, 4 years ago, it's down to 0.6. And if you guys pay attention, a market imbalance is somewhere between 4 to 6 months. It's considered an imbalanced market. So we're still underneath that number. Pending sales, 6,600. There he is, a handsome devil. Glad you could make it, AG. 6,600 pending sales as opposed to last year, 6,600, same flat. And the days on market are slightly up, 45 days as opposed to 37. But again, pre-COVID, it's down from 55 to 45. AG, can you hear us?
Loud and clear, my friend.
There we go. Speaker's working. So excited. So anyhow, that is Houston. And I don't know if you guys have any comments on the market. AG, welcome. Or if you want to just kind of give your bio and what you've been doing. We've known AG for quite some time.
I know.
It's been a while. Good to see you again.
I was going to say, I must say, Jeff and both you, Wade, continue to get sexier by the hour, man.
Very kind.
I'm blushing. So what have you been up to lately, AG, with your building company?
Yes, it's exciting. I shut down real acquisitions in 2022. I've been a long proponent in general in business, and especially in what we do, real estate, that whatever we do has to have an inherent value. Sales and marketing is one side, creating revenue from ultimately sales and revenue should come from things that genuinely add value. And the cost of running a tech company was outpacing the revenues that we were making. So the company died a natural death around 2022. But we had a wonderful run from 2009 to 2022, made some good money, I think we added a lot of millionaires to the Houston market with our data. And of course, met some fantastic friends like you folks along the way.
Absolutely. And so tell us a little bit more about your endeavor at the moment. Yeah.
So 2013, I had started kind of getting envious of all the folks that were using our data and building what I have always believed adds genuine wealth in America, which is owning of real estate. So 2013 is when I added a list of companies which essentially focused on single family buy and hold. And what we were doing at the time were buying properties that had a gross 14% yield in the single family space. And you've been around a long time, Wade, to know what exactly I'm talking about. There were markets like Alief, Missouri City, certain parts of Chinatown, Bel Air area where those yields were very easily accomplishable from single family. So my wife and I, started buying these single family homes, and the company was called Alexander Green. And what we were essentially doing them was remodeling them and just leasing them out. We peaked in 2016, where we owned about 108 homes in Houston, right? Most of them inside the Beltway 8 market. And then 2016, the yield started really falling as a lot of folks started getting in the single family rental space business. I think the market also came to realization as a lot of institutional buyers like Blackstone were getting in that space. So it's becoming extremely tough. Zillow came in the market making stupid offers. So the yield that we were getting on single family buy and holds just stopped. And since 16, then we switched to multifamily. So we renovated, and we leased two multifamilies. We still own one of them. But the same thing happened with the multifamily around 2019. The cost per door and the actual yield was becoming ridiculous. We were not able to compete with people who are making 2.5%, 3%, 4% cap offers. There was no cash flow at all. So what we started doing then was actually building for ourselves. So since 2019, we've been focused not just on remodeling, but essentially on ground up construction. So far, we've built and delivered to our investors seven multifamily developments from 50 units to our biggest one is 160 units around Houston. Currently, we have developments under progress. If you go to alexandergreen.com, you can see exactly where they are and what the stages they're on. And as we go along, I'd love to share my perspective on what our investment strategy has been and what we believe to be a winning strategy for the next few years, where we are placing our bets.
Great. Well, it sounds like it's been an interesting and ever-evolving path for you, but very happy that you're doing well. I'd love to hear your insights as we go through the market. I did want to talk about a couple things in Houston in particular that I did notice, and I always look at Houston in comparison to the other major metros. And one very interesting thing is that in comparison for months of inventory, Houston is 0.6 months below pre-COVID number, and they are the only city amongst Houston, San Antonio, Dallas, and Austin that has that component. And then also looking at days on market, only Houston and Dallas are below the days on market from pre-COVID. So it does seem as though the market is moving more rapidly here in Houston than the other major metros, and that's a really strong number compared to what we considered steady state back in 2019. So that was one of the biggest things that jumped out at me regarding Houston. Anything else in particular in Houston that you see in this data here, AG?
Yeah, I would agree with you, Wade. One of the things that we always keep a very close watch on is volume and inventory. And you're absolutely correct that the volume numbers in terms of dollar volume has kind of sort of maintained its levels from last year, unlike most markets in Houston. And inventory is also, just like you said, below pre-COVID levels. But one of the things that I do want to add to this is a different market where we were about less than a year ago, meaning anything that you could put out there was flying off the shelf at over asking. And I mean, average days on market, I do a lot of business in West University and Bel Air. Our days on market here were a few hours. Our premier lots, we do a very good job in locating our properties and our parcels very carefully. But even then, we were moving these assets within a few hours of getting listed. That has changed. So just remember this in mind, that a lot of this data is at the macro level in Houston. If you are listening to this call, the classic rule of real estate, which is your five undying principles. I know you guys talk about it all the time, which is location, 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 was never truer before than it is today. So just be very careful of where you're doing your deals. If you're inexperienced in the real estate space, have somebody in your team that does a very good job in helping you understand what is the difference between a good location and a bad location. And the second thing I'll say, that the other reason why you should be a little careful about this low inventory number is, even though the dollar volume has not gone down much, the active number of listings has. I think about 1,000 listings less than last year, if I'm not wrong. Yeah, about 11% down from last year. So what that essentially tells you are people are just sitting tight. People are holding on to those 2%, 3%, 4% rates that they got in the last couple of years, and they're sitting tight.
For sure. Yeah, and but I definitely think there are fewer sellers, but I think there are lots of buyers despite the higher rates, and that's why inventory is so limited, especially in
True.
Houston. So
Very true.
it's I don't think most people would have assumed the days on market would be at the level they are today with rates where they are today. It's really, I would not have guessed it either, but that shows you that there's so many people moving to the state. And I think this is very geographic. When you look at other parts of the country, days on market are definitely higher, but we're fortunate to be in an area that is being buoyed by a lot of people moving in, solid economy, and still significantly more affordable than the rest of the country, even though it's not nearly as affordable as it was, a year and a half ago. That's the simple reality of it. And we're going to cover some slides that talk about that affordability a little bit later on. So diving into Dallas.
Next slide.
Yeah.
Okay.
Thank you, Jeff. Dallas is, without question, since September 2019, the fastest growth, most incredible growth. You look at average sales price of 57.5%, median sales price 50.9% over that time frame. It does have flat months of inventory, but still more attractive months of inventory than Houston had. And then the days on market is less than pre-COVID. Really an amazing success story. Overall average sales price is up year over year, 3.7%, median down 1%. But if you look at these numbers relative to the rest of the country, definitely Dallas and Houston are far more resilient than the national numbers. We always talk about that with the people on the call, and in general, is that, to your point, location is incredibly important, and that may be in streets, that may be in neighborhoods, that may be in cities, but it's very dangerous to look at real estate numbers on a national level. I think that does not tell the entire story. And Dallas is a real amazing success story with how they have weathered the market. So many major corporate headquarters and other types of businesses moving in there, that's really buoying those prices and the market despite very, very high interest rates compared to what we had a year and a half ago. What do you guys,
Sure.
you guys see anything else in this data or in particular about Dallas?
Just in general, AG can give his thoughts, but anecdotally, Dallas has it's been a great market. Like, it is still humming right along. If you look at those during the pandemic, and it's still higher, right? The average sales price on this property is higher. The months of inventory of 2.8 is still a very solid number. Like you said, there are tons of corporations moving to Dallas. I saw an article recently that had some predictions for some relatively distant future, but they said that the Texas, and in particular the DFW area, would be possibly the largest metro in the country. Like, it's growing leaps and bounds. So Dallas is a really strong market right now, despite the interest rate market. AG, if you do any stuff in Dallas, or if you just have any thoughts on it.
I haven't done very many deals in Dallas. Back in the days when I used to wholesale, I did something, but I'm not involved in the market at all. Austin all day long, Austin and Houston, but Dallas, no.
Okay. Well, we'll get your viewpoints on Austin in just a moment. That's our fourth slide coming up. So Jeff, you want to talk about San Antonio a little?
So yeah, San Antonio, it's a little different than the first two, in my opinion. So sales are down from 2,700 to 31 to 2,700, relatively flat pre-COVID. Values, again, COVID a year ago, they're -1, -5, so a little bit lower numbers than, say, Houston and Dallas, obviously. If you look at the right number, though, it's still over the long term. You're talking 40%, 30% returns. Months of inventory is higher than the other two, 4.4. I think it's the highest months of inventory we're going to see is San Antonio. And days on market, 64. So Austin and San Antonio are very similar. I think they've had a little more of a slowdown when it comes to the market lately than, say, Houston and Dallas. They've taken more of a hit, but I will say I read articles all the time talking about San Antonio and how in the long run it is a very solid play for buy and hold investors. not to spoil the last slide, but we always look at the affordability index. San Antonio is way down the list. Like, it is still very affordable to live there. So that tells me that there is plenty of room for upside long-term on those properties. It's like in the 60s, which is significantly lower than the other big three as far as affordability goes.
Yeah, we actually covered an article maybe 2 months ago from a very reputable group that said that San Antonio had the highest upside of all the real estate markets in the country. So that was a very interesting article that we covered 2 months ago, if you want to go back and check that out. And I am currently in San Antonio. That's why my camera is at somewhat of an odd angle. I'm in a hotel room, and unfortunately, GoToWebinar does not allow me to alter my background. So it is what it is. You guys are going to have to see what you see. But some things that I picked up anecdotally here, and just I think important information to pass on, is that there are still a lot of active investors here. A lot more people are doing flips at the moment, but really savvy investors are still aggressively in the rental market. They're looking at the deals not as enormous cash flow at the moment, but they are looking at chances to get excellent equity capture. The equity capture that they're seeing out here, really strong, limited out of pocket, about half what it was before rates went up, and people will be able to refinance at a later date and get greater cash flow. So that's a lot of the theme here. Another thing to really keep an eye on is that there's a group called the Strike Team in San Antonio that is out looking for people that are not getting permits. So we and almost every other mentorship group, wholesale group, is encouraging people to pull permits on everything, because they are out actively looking for properties that do not have permits, and it can really become complicated. So if you are a San Antonio investor, definitely bake that into your numbers. It's going to cost about $1,000 to get all your permits. May take a little bit longer to get through your rehab. Still an excellent market to invest in, but it's better to do that up front, because there's a high chance that you are going to get caught. And I know in some other cities, like maybe Houston, Houston, Austin, Dallas, that may not be as big of a concern. Some investors do permits on every deal, and that's the safer approach for sure. Some people sometimes, if it's a very light rehab, try to do it without those, but that's not advisable in San Antonio with the focus that they have on looking at, especially if you're flipping. If you list a property on MLS, they're going to come out right after. They're looking at MLS regularly and coming out and seeing that if you didn't have permits, they're going to come out and
yeah, it's a big deal. So like Wade said, anybody doing deals in San Antonio, they need to get permits now. I talked to a couple of different people that are in the market in this area. This is something that's going on regularly. Like Wade said, if you pop a property on MLS, they're going to visit that. Even if you're doing it as a rental, I think they're driving around so much looking at the flips, you're gonna get caught, right? There's no way not to get caught. They're driving around all the time, even if you're rehabbing a rental. So it's worth the $1,000, $1,500 to do the permits. The alternative is significantly worse. So just suck it up and get the permits. It's going to take a little bit longer, but it's way better than getting red tagged when you're almost at the end. And then depending on the inspector, they can ask you to open up walls because they didn't approve the plumbing or the electrical and whatnot. So it can get really expensive really fast. That is a good point, Wade.
Last thing I'll say is that it does seem as if, while they are trying to make sure things are more permitted, what we have heard is that if you do this up front, they are being relatively cooperative and not overly strenuous on they're not trying to make people's lives difficult. They're trying to just make sure that things are monitored at a moderate level. So I don't think it should push people out of the market. I don't think you should be afraid of it. Just to understand going in, the mathematical bet, the better financial bet is to go and get your permits up front. Now let's go to the spot next, where AG has a lot of experience and is doing some deals recently. So
I was going to add one thing, if I could, on San Antonio.
Oh, sure.
Yeah.
Just one little anecdote. There's an index in the United States, I'm trying to remember the name of that index, which measures the locations with the least likelihood of natural disasters, where quality of life in the long run will be great because the likelihood of being disrupted by various natural disasters is the least. Guess which city has consistently ranked number one in the United States for that index?
San Antonio.
San Antonio.
Way to go, Jeff. Great guess.
Gold star, baby.
That's interesting.
Yeah,
That's a nice
that
answer.
makes sense. They're going to get the freezes, hurricanes, tornadoes, nothing like that, really. Floods.
Good.
Okay, dropping knowledge, AG. Appreciate it.
No Californians, no liberals. We're okay.
Oh, that's funny. So diving into Austin, Austin was the absolute hottest city in the entire country, right? For a while there, but before rates went up. But if you look now, median sales price year over year down 3.8%, only up 41.3% since COVID. I mean, if you look at the other cities, that's about a little bit less than San Antonio, way less than Dallas, about on par with Houston if you look at the entirety of that time post-COVID. Days on market up significantly from pre-COVID, 49 to 65 days, up 16 days. Months of inventory up from 2.5 to 4 days, so up pretty significantly there. And the median sales price also down slightly. So whenever you bake in all these numbers, Austin was incredibly hot. Honestly, it needed to have a normalization, and I think it has. And Austin does not have the tailwinds that Dallas does, or even for that matter, San Antonio or Houston does at the moment. But I do believe that there are some buys now in that market, and I hear that savvy flippers are making some things happen there. So I know you're a little bit in that space, more new construction than flipping necessarily, AG, but tell us your insight into that market.
Well, yeah. So before I talk about Austin, I'll give you a little, I guess, precursor to where I'm going with this. See, one of the things that I've realized, Jeff, in being in real estate, I started in 2009, um, and I personally entered the space after the 2008 correction. And we've seen minor corrections between 2009 and where we are today. But one of the things, sorry.
Oh, there we go.
But
This
one of the things
point
I'm
was so
very,
important, AG, for dramatic effect. Turned off his camera.
I know. It's like
Who's listening?
the strategic pause. Oh my gosh. Give me 1 second. I'm being constantly. Yeah, I'm connected from my phone. So
There
when
we go.
somebody calls, it gets disconnected. And I'm connected from my phone, so when somebody calls, it gets disconnected. So I'm sorry for that. Um, hopefully it won't happen again for the next few minutes at least. I was going to say one of the things I've realized very quickly over these years is um, you have to develop at the end of the day an inherent investment strategy. I understand that a lot of the people listening to this call probably are in the new real estate space. But one thing I will highly encourage people to do is pick up uh, certain literature, certain philosophy, certain guides, or mentors like you folks. I learned tremendously when I was new in the space from hard money lenders and people who were deeply invested in my deals, like you are. I mean, you are at this point, you guys up to what? On your rehabs, you're at 70-80% LTV, LTC?
We don't have an LTC requirement, and we go up to 75% on certain deals, 70% on larger deals. Yeah.
So you're heavily invested in the success of who you're lending to. And who better than guide and coach newer real estate investors than somebody who's invested 70% into his or her deal. But having said that, one of the investment strategies that I developed was I was always going to focus more on being a cash flow investor. I realized that having lived and seen a lot of people who did real estate investments for the purpose of making a quick cash or increasing their liquidity, the capital reserves, did well. But eventually, the guys that always came out on top and built a generational wealth. I've been a big believer in the concept of generational wealth. Are guys that understood that at the end of the day, real estate wealth should be about creating residual, long-term, passive, inflation-adjusted cash flows. Um, and the reason I'm mentioning that is a lot of people who are making major bets in real estate today are guys who are cash flow investors. Austin is a similar market. Yes, you're absolutely correct. What you're seeing in Austin is definitely a correction, which was due. We were we were due for a correction in Austin with all the craziness that was happening there. But there are a couple of caveats. The first caveat is that the numbers that you're probably seeing are from ABOR, I'm assuming. You should say somewhere in this slide.
Yes.
Does.
They are ABOR numbers. So ABOR numbers are not fully comprehensive. I think majority times ABOR focuses on Hayes County, Travis County, and Williamson County. But a lot of activity happening outside of these three counties is sometimes not captured by ABOR. They're not very comprehensive in the data capture. So the amount of activity that is happening between the Houston-Austin corridor, between the San Antonio-Austin corridor is absolutely insane right now. And if you factor those numbers in, a lot of these things that you see will get changed, will get skewed. In fact, I was looking at the data specifically for what's the county between San Antonio and I think it's Comeaux, if I'm not wrong. Guadalupe, Gonzales, and Comeaux. Between Guadalupe, Gonzales, and Comeaux, the sales activity, the inventory, and the median sales price has, for the first time, outpaced what's happening in Travis and Hayes. So just some major bets happening from large housing developers, commercial developers, industrial developers in that space. And I say that with a caveat that, of course, whoever's listening to this, don't just make investments without doing your own due diligence. But Austin is not to be laughed upon or not to be said, well, put it to the side. What's happening in that space is already done. Some major players have come in the last 10 years and they've made some crazy investments. And those investments, they're so deeply invested in that space right now that, there may be a small correction, but it's just not going to go away. And frankly, corrections like these are fantastic for long-term players like us. That allows us to be strategic about our investments. It allows us to negotiate hard. It allows us to have breathing room and do proper due diligence. Earlier in Austin market, I couldn't ask for a 90-day or 120-day due diligence period. No issues now. We are buying 50, 60 acre tracts, and it's impossible to finish your due diligence in what we were getting handed down last year, which is 35 days, 45 days max due diligence. So we are back to normal due diligence stages, but the reduction in prices is zero. In good class, our motto for our company is Class A locations, Class B product. Class A location, Class B product. We have not seen any reduction in pricing. Just the terms are more agreeable, but the pricing reduction in any of these locations in Class A is zero.
Wow.
So basically, it's connecting the two is what it sounds like. Like anything north of San Antonio and south of Austin is where it's happening.
That diagonal corridor, yeah. And similarly, Houston and Austin.
Yeah.
I would assume that those areas are booming because it's commutable to all these major areas, but more affordable in a higher interest rate environment. So instead of paying up to what you would, especially in Austin, but also in San Antonio and Houston, these areas in between, you can get affordable housing, so have access to the jobs of those three major cities.
And they're on major corridors. We're
Yeah.
talking about I-35 corridor, 290 corridor, I-10 corridor, very accessible.
Yep, for sure. That's great info. Thank you, AG. Let's get to this next slide here. This is a macro number, but it's very interesting. And you look at where home equity was back before the great financial crisis, below 10 trillion, and now we're up at 16.1 trillion in home equity. So a lot of things that I think you can take from that. One is that people do not have a desire to sell, right? Because the lower interest rates. But if they get into a financial spot, there's still a robust market because the days on market are low. People are still buying. There's the complete lack of inventory because of the low interest rates. But then also, if someone needs to refinance to get out of a spot, they have the equity with which to do it. Now that may be painful, but they could do a home equity loan, pay off credit cards, other things like that. So it's one of the big reasons that we don't see this foreclosure boom that people have been talking about for a long time. I think that there are going to be corrections more so in the commercial and multifamily spaces because of the net operating income calculations and because traditional home buyers do not buoy that market. But you know that this is a really big equity number, and equity in a home is one of the biggest ways that homeowners can avoid financial calamity and stay out of foreclosure. And Jeff, I think this is a very exciting number when you think about it from that perspective. Any other thoughts there?
No, it's like you said, it's back when the financial crisis hit, there was a lot of things going on, but one of them was there was just not this much equity. Like it just didn't exist. And the other thing I was thinking about was, rates are higher, but thankfully nobody's been selling 228s and 327s. So if they were, we'd be in a different spot, I believe. But no, this is great. This just means that there's access to capital for a lot of folks if they have equity, and if they maybe don't have the cash but they want to get into investing. Rates are kind of normalizing, and people are getting used to the fact that they're not going to get a 2% mortgage anymore. You can tap that equity and start investing in properties if that's your plan. If you don't have the resources now, because on long enough timelines, even going from a 3% to a 7%, you take that money and invest it in properties. If your goal is a long-term play, the numbers get real silly real fast.
Yeah, no, that's a great point. All of the great real estate mentors say debt equity is not an asset. It's just an unutilized asset, right? So if you have equity somewhere, you want to do like AG said and use that to get into the game and build generational wealth for sure. Let's look at this next slide here.
There he is.
AG's back. So AG, this slide here, it's a very interesting slide. We saw this data, and Jeff, I'm looking forward to getting both of your opinions. But basically, at the end of the day, what this is saying is that today home buyers must earn about $115,000 to afford the typical U.S. home. Now, remember, this is national numbers, right? This is small town in the middle of Iowa, and this is New York City, all averaged out, right? So keep that in mind. But that's about $40,000 more than the typical American household makes today. And look at what the requirement was just a few years back in 2012, 51,000. Back in 2020, pre-COVID, 74,000. So one of the reasons that I am super excited, and I think AG and others are, about having real estate is that it's unfortunate for the American homeowner, but it can be an opportunity to provide great housing to people that need it for the real estate investor. But these numbers mean that people are not going to be able to get into homes as easily, and that there is going to be continued ongoing upward pressure on rents. Now, that cannot be bumped up right away, and I did a lot of studies on this, and we don't have any of the data here, but in times of inflation, there is a lag on increases in rents. We're in that time right now, but eventually that must happen, because in high inflation times, rates are increased to ward that off, and then it starts to become mortgages become less and less affordable, and so there's a lag in time, but the rents eventually go up. But this chart is really telling. So right now, whenever people are getting into homes, there are two things that are going to push up the rents over time. So if you get into a home and your cash flow is less, over time, this factor is going to increase rents, and if you can eventually lower your interest rates, you're going to have that double impact. Any other thoughts on this chart? AG, have you seen this one?
I have. In fact, when Derek forwarded to me, I was looking at it, and this is I think a vindication of some of the bets that we've been making in the U.S. residential market, specifically in the BTR, built to rent space. So we really believe that eventually U.S. will normalize to where majority of the world is, which is a 60% to 40%, 60% ownership, 40% rental. We were a 72, 73% home ownership country And I definitely believe that in the next decade, we'll be like the rest of the world, which is 60% people own homes, 40% people rent homes.
Hmm. Yeah, we consistently try to put things in place as a country. It's a noble effort to try and get those numbers up, but I think oftentimes those efforts have unintended consequences, which is really what happened back in 2005. I think a lot of that was a lot of programs that put people into homes that really could not afford them or did not have the financial discipline to be a homeowner, and well, there were definitely consequences. So I think that number, there's a lot of history to your point, AG, to say that that number is often the right number statistically to be at that 60-40 ratio. And you
Well,
know, go ahead.
a big part of the reason why we were such a high home ownership country is because of Wall Street. Wall Street pepping up the mortgage-backed securities as a fantastically important investment vehicle. And there's tons and tons and tons of studies that have debunked the theory that this American concept of creating wealth through home ownership is not necessarily true. Definitely not necessarily true for everyone.
Mhm.
So yeah, absolutely. 60-40 is the place to be. That's why our bets are in the build to rent space. And one of the things that we've started doing though is, and this may be a little advanced for some people listening to this call, is we essentially buying down debt and offering lower interest rate to our buyers as developers. So we get them into essentially a seller financing situation with a lower interest rate that we are able to offer and lock them in. Because at this point, we can buy our debt down.
It's interesting.
Next slide. There we
Jeff, do
go.
you want?
So this is just it's kind of based on the last chart. Typical U.S. home buyers monthly mortgage payment is $2,866, which is an all-time high, 20% up from a year ago. But look at what it was just 3 years ago. That's real money, like $1,300 a month extra just to buy a house. That is why we're seeing people, like you said, exit the home buyer market and enter the home renter market. It's just way more expensive. And this is showing that. There's a slide a little further down talking about rents. It's Houston specific, but it kind of backs this thought up that there's a lot more people looking to rent now because they simply can't afford to buy a house. And if you're a investor trying to do buy and holds, it's a great spot to be because I think that's going to continue for a while.
We've looked at this chart a few different times in different ways, but this is an interesting chart to see. And basically, it's the number of U.S. homes constructed annually, and we're looking at single and multifamily. And you see just an enormous boom in that single family space. And I'm sure many of you have seen our charts in the past that we've used or seen them elsewhere. And even going back to the 60s, 70s, 80s, 50s, I mean, definitely adjusted to the population. We're building far fewer homes today than we did at any of those times. But looking at this chart, the multifamily is, still not at a level where it was in the late 80s, 70s there. And this is not inflation. I'm sorry, this is not population adjusted numbers. This is just flat numbers. So the 1.2 million single family homes still not at anywhere near the peak. And if you go back historically, there was time definitely in the late 70s where there were more homes being built than there were today, late 80s. So, and this is what I think we're all agreeing is leading to this lack of inventory, despite not being homes being sold. It's just there's not much out there, right? There's not much out there. So people like AG that have the financial ability to do development and build homes, there are definitely a lot of people in that space. And then people who are not in a position to do that yet are really taking advantage of the fact that you can remodel homes and it's a different approach, but providing this rental inventory, it's got to come in a wide variety of ways. And if you are in a position to do what AG is doing, I think that could be an excellent vehicle. And then if you're not, but you're able to remodel properties and build out a group and a team that can do that affordably and efficiently, that's another way to help that inventory out as well. Anything else to add to this slide?
No, I think we're running up against it.
Yeah.
I guess all right. So this is pretty interesting. I thought share of list price, the average U.S. home sold for pre-COVID. So, as you can see, was below 100, which is what you would expect in a normal market. COVID hits and it shoots up to 103 really at its peak. And that just shows you, now things are coming back down to a normalized size, but it just kind of shows the run up of who has the advantage, buying or selling. When you look at this number, the 100%, it's just kind of like another marker that shows we're kind of getting back to a normalized market where it's not, you're not getting 103 of your ask. It's not that super competitive anymore.
Next slide. This is a very powerful slide. Now, this is asking rents. This is not executed rents, but look at the trajectory from 19 to 20 to today. It hovering in that 16 to 1750 range, and now at over 2,000. That is a really game-changing number. Now, admittedly, taxes have gone up, insurance has gone up, especially in areas like Houston where you have issues with flooding and other things like that. So there are upward pressure on expenses as well, but that's a powerful trajectory on rents. And I don't think we've seen the end of it. I think this number is going to continue to go up over time. AG, what do you see in this chart, and what are you seeing in the properties? I don't know. Do you still have any properties, or did you sell all those properties? I don't know where you're at.
No, we still own about 40 some single SFRs in Houston. The one thing that I was gonna piggyback on what I've said before, which kind of again exemplifies in this chart, is there is a different class of a tenant at each rent bracket. People who are renting homes from 1,000 to 1,200 bucks, from 12 to 14, 14 to 16, 16 to 18, yada yada. All of those differ. And again, as a long-term buy and hold investor, if you're listening to this call, it's very important for you to identify which tenant class do you want to buy and service your real estate for. And equally important, which tenant class do you have the ability of properly managing? Because if you want to collectively, effectively collect rent, it's not just about managing real estate, it's also about managing your tenants. And having the right skill set in both property as well as tenant management is absolutely key. I don't know if you have it somewhere, but I believe the single family median rent in Houston is right around $1,800 today, which is more or less remained flat.
Funny you should ask. Our next slide is about the single family rentals in Houston.
Okay, what does it say? But
there you go.
1839.
There you go. So it has more or less remained.
No, that was 4 years ago. It's
really?
gone up. Yeah. So this is I wanted to include this because it's like I said, for buy and hold investors, it's a positive story. As it becomes more and more difficult to afford a house, more people are jumping into the single family rental space. So if you look down at the bottom there, single family home rentals are up 19%. In September 2019, leases were 20%. That's the volume, but as far as the average rent, it's 25% higher than it was back in 19. It was 1840. It's all the way up to 22. Now that's average versus median, so maybe that's where you're getting your numbers from, AG, because I would think average would be higher.
Correct.
But just year over year, it's up. What is that? $100. And that's what we tell people all the time. It's like, if you can get a good deal, even if your cash flow is relatively moderate, yes. If you can get a good deal, very little out of pocket, you find the right buy, it's worth it because things are working in your favor. The rents are going to typically over time, rents are going to outpace your taxes and insurance. And God forbid rates start going back down, there's always the option of refinancing. So if you're able to get into a deal, it's all about when you buy. Like if you get into a deal with little to no money, no money is not right. But if you get into a good deal with a good equity capture, not a huge number out of pocket, Even if the cash flow is light, it's only going to get better, is my point.
So we
So
are.
what?
Go ahead, AG. I'm sorry.
Yeah, I was gonna say that. So the bet that we made, Jeff and Wade, was the housing on the tenant space about 15 to 20% plus minus the median rent. So the target that we shoot for on the single family as well as the multifamily space is is in this case plus minus $200 of 1,800. So we're targeting the $1,600 to $2,000 single family rental market. And of course, ours is a newer product. That's the reason I go back to what I said before, which is Class A location and Class B product. In terms of finishing, in terms of not the quality of construction, but just the finishing and the amenities are not there. It's just good, solid construction, good, clean housing. And that's the exact market that we're going after, 16 to 2000.
That's great. So we are rapidly approaching our deadline here. So I'm going to go over a couple specific slides to make a couple points. We could go to the next slide, please. This is very interesting that if you look at CoreLogic, they're one of the better data analysts out there, access to tons of data, and they do a good job analyzing it. You look at the projection for areas that have low, medium, high, and very high probability of prices dropping. We talk a lot about this is a national evaluation in many ways, but it's also a geographic. Look at Texas. I mean, definitely the most green and purple. The West Coast, all red. East Coast, almost all red, other than a couple of spots of purple. And just really only one spot of red in the entirety of Texas. And also, you know, we have a lot of people who are from Oklahoma that are investing in that area, lots of purple there. The entire Sun Belt, Rust Belt, whatever you want to call it, is a more positive area. Surprised that Florida and Georgia and some of the Carolinas are not in that category, but a successful prognostication, certainly for Texas investors and others in this Sun Belt, Rust Belt area. So in the effort of time, not going to talk about the next slide on rates, move through that. Housing starts, we looked at it in a different way, but this is a historical view from the 60s on. Almost all of those decades with far fewer people building as many or far more houses. A point we've been making, that's the reason for lack of inventory. Next slide. Very quickly, rental vacancy. Look at these numbers historically. For the past, since 2000, rental vacancy is always far higher than they are today. Rental vacancy rates actually quite low whenever you look at it overall. The other time it was comparably low, another time of very, very high rates, right? Harder to buy homes, people have to rent, and the rents are far more in demand. So this is a positive story for real estate investors as well here. And I want to get to this affordability index. We'll skip that next slide. It's just a population number, kind of we've been talking about it. But I wanted to get to this slide and talk with you guys a little bit about it, then we'll open it up for questions. We've been looking at this pre-COVID a year ago and today, and you look at Houston in particular, pre-COVID is the 23rd least affordable city. Then it was the 37th least affordable city. Now it's the 41st. So it's becoming comparatively more affordable, which is a real success story. Dallas and Austin's the only one that is today less affordable than it was, I think, before. Dallas is also a story that's kind of it was 19 before, 25 now. San Antonio definitely very affordable, 64th overall. So these major metros in Texas and a lot of smaller markets in Texas, great amenities, great job markets, and highly affordable. Anything else that's jumping out from the page from you guys before we open it up to questions?
No, just more what we talked about. Like I said, Houston and San Antonio are still, relatively speaking, for what you get on a large city, they're very affordable when compared to some of the others out there. And the smaller towns too, like, talking to our manager in San Antonio, a lot of folks are jumping into Corpus Christi as well. They see that as a good value for for investors, buy and hold. So plenty of opportunity there in Texas. It's a good spot to be. We're lucky.
Amen.
Okay, Derek, if you'll join us, if you want to reach out to AG before Derek hops on, you can reach out to him at 855-732-8528. And Derek, do we have any questions today?
We do. There was a lively kind of chat session going on during the comments on San Antonio permits, how to play your cards in light of that level of attention that they're getting in the San Antonio market. It had normally we get questions, we get some chats, but this kind of had a little back and forth that I thought was lively. I definitely think you hit on a hot topic there. And then the one question after that was, what are the one or two best plays considering the current real estate market? What are one or two best plays you can make to take advantage of the current market, I think is what they're asking.
Do you want me to take that?
I know what
Yeah,
AG's going to say.
Yeah,
Go
I
ahead.
mean, affordable housing, ground up development of affordable housing. It plays into all the checks all the right boxes. You're catering to the increasing demand for people that are looking to rent affordable units around, again, the median rent or below the median rent or around the median rent of that city. You are getting investor capital for these BTRs, which is tons of capital in the market space right now for BTR products. Again, if you look at the affordability index, even though Houston market is what you said 41st,
41.
ranks 41, which means it's 41 worst city to live in the United States. People are only spending 40% or less than 40% of their income on housing, which is nothing. So I think it's if I have to check something, I'd say affordable housing, ground up development of affordable housing.
And if you're looking to build your team to find that, like Wade mentioned, he's in San Antonio. We had a great event yesterday in San Antonio as our VFP Mixer. If you've been hearing about that, we'll be in Houston in November. We'll be back in Dallas in December. So be looking for those. Ask your loan officer for details on when we're coming to your city. Like I said last time, kind of like college game day when they play that song, "We're coming to your city." But we're glad you joined us today. We did have a winner for our real estate market update. Today, half off your next hard money processing fee goes to Annette Clairbeau. And so, Annette, congratulations. With that, I'll turn it over to the guys. AG, thank you so much.
AG, really thank you for your insight. I think it's a different perspective and different insight than a lot of our other guests have had. So appreciate you talking about the build to rent space. Not everybody on the phone today has the capabilities of doing that, but it's a very nice perspective to hear. And I think a lot of the overarching themes still resonate with a lot of the people who may be on the phone and are newer and maybe starting off with a fix to rent, maybe a fix to flip, something like that. But the overarching theme is that providing affordable housing to people is extremely important in the current environment because homes are very difficult to buy at the moment. And there are a wide variety of ways to do that, many of which we can help with. And then also, as you progress in your journey, it does sound like this build to rent. I know a lot of people moving in that space, and I think it's a very exciting space to be in as well. So thank you for your insight. It was great.
Thanks for having me. We really appreciate it. I just want to say that the phone number is for real acquisitions, an old number. But if you go to alexandergreen.com, which is ALEXANDERGRENE, alexandergreen.com, you can get our latest information. We'd love to hear from you. Feel free to reach out to me and my team if you want to come and see any of our commercial developments. We're doing all over Houston. We'd love to show you around.
Excellent. Thank you, AG, as always. Best wishes to you, my friend. Have a great one.
Good seeing
I
you
appreciate
again.
it, right, Jeff? Thanks again. Derek, thank you.
All right, be good.